Hi everyone, and welcome to the Everyman Investor. So for those of us who have been following the markets, we do know that the stock market has been in a slump for the past 6 weeks or so. At the same time, US Treasury yields as well as the dollar index have been rising in strength. I'm going to take this opportunity to use this video to explain the relationship between Treasury yields, the dollar index, and stocks. Now, to understand why Treasury yields rising will cause the stock market to drop, we can look back to our old friend, the equity risk premium. Now, given that the current 2-year Treasury yields are ranging in the range of 5 to 5.1%, and the 10-year Treasury yields is about 4.7 to 4.8%, holding on to the SPY minus capital gains will lead you to an annualized return of 2.5% or thereabouts in terms of your equity risk premium. Meaning to say, for the risk of losing money in terms of share price volatility, or in the case of a share price dropping over the next year or so, you are actually just getting an extra 2.5% or thereabouts in terms of your profits. So assuming that share price goes up, the equity risk premium works to your favor. If the share prices continue to drop, then holding on to treasury yields actually would be a lot better off in terms of portfolio profitability. So now let's take a look at the chart for the SPY versus the 10-year treasury yield. So the 10-year treasury yield is in black and the SPY is in red. Now, as we can see, every time treasury yields spike, the SPY drops, which is explained by the equity risk premium. And given that current yields are very, very high, and the outlook for the economy is not exactly certain, it does make sense to actually either stop investing in stocks and start exposure to treasury bills and government bonds, or even freeing up capital by selling stocks and investing in treasury bills and government bonds. The current treasury yields, as you can see, many of them are above 5% at the moment in time. The benchmark will be the 2-year and the 10-year, which is at 5.08 and 4.8% as of this presentation. This is abnormal. Now, in a normal circumstances, the longer duration yields usually yield higher than the shorter duration yields, which is very understandable. If you hold on to something longer, you should get better rewards than if you hold on to something shorter. Now, this current situation whereby the shorter yields yield higher than the longer yields is actually abnormal, and it's what we call a yield curve inversion. Now, what is a yield curve inversion and why is it important? So from realinvestmentadvice.com, the periods in red, as you can see here, are the periods whereby the yield curve has been inverted, meaning that the 2-year yield yields higher than the 10-year yield. And you can see the grey bars after these periods where the yield curve inverts, and these grey bars actually indicate periods of recession. So, meaning to say that the inversion of yield curve actually predicts a recession quite accurately. Now, the question is whether or not we have had a recession, or whether or not we are going to have a recession coming. So from the Bureau of Economic Analysis, the GDP data for 2022, as you can see in Q1 and Q2, GDP growth was negative, and 2 consecutive negative GDP growth quarters actually is the definition for what we call technical recession. The thing is, technical recessions are not actually recessions, because recessions are called by economists based on GDP growth or negative GDP growth, as well as employment data and other various economic factors. But 2 main considerations are employment data as well as GDP growth. Now, during the period where the GDP growth was negative, actually unemployment was very, very low, and the employment data was very, very strong, which is why the economists did not actually call a recession. The thing about recessions is that usually they are called in hindsight, meaning to say that the economists will say that a recession happened during this period of time, and the recession is now over already. So for the optimists, the recession is past, and we can look forward to continued GDP growth and a good economy. Whereas for the pessimists, this is not technically a recession yet, and the recession is still to come. So for the pessimists, it makes a lot of sense to actually stop buying stocks, or to even sell stocks, to buy fixed income, which is guaranteed in terms of capital, and also for your yield if you hold it to maturity. As you can see, this is the SPY price. And from the late 1990s to about 2013, between the dot-com bubble and the global financial crisis, stocks were actually flat, which means to say that if you had bought, say, a 10-year treasury at 4.8%, you would be getting 4.8% plus your capital back after 10 years, given that you held it to maturity, assuming that the US government does not go crazy and bankrupt the country, which is the assumption that I'm making. So it will make a lot of sense if you are predicting a coming recession with falling stock prices or flat stock prices to get that locked in 4.8% yield for a 10-year period, or even a 5% yield for a 2-year period. The other thing I'm going to examine is the dollar index versus the SPY. So the dollar index is in black and SPY is in red again. The dollar index actually measures the strength of the US dollar against various other currencies. As you can see, in periods where the dollar index has strengthened, the stock market has actually dropped. So what is the relationship between the Treasury yield, the dollar index, as well as the stock market pricing? So, Treasury yields rise, there is an increased demand for US Treasuries. And to buy US Treasuries, you need US dollars, which leads to an increased demand for US dollars, which leads to an increase in strength of the US dollar versus other currencies, and an increase in the dollar index. Now, for the dollar index versus the SPY, we already know that Treasury yields that rise actually put pressure on stocks, and stocks go down. The dollar index works in similar ways. So, increase in the dollar index is to say that multinational companies who are earning from various regions outside the US. So, for example, say you are a company who is listed on the New York Stock Exchange, and you have got revenue from, say, 50% of revenue is from areas outside of the US. Meaning to say you earn in, say, pounds or euros or yen or whatever currency you are earning from, but you have to report your financials in US dollars. So, based on the currency conversion, if the US dollar is strong, your revenue and earnings from other regions outside the US will be lower after currency conversion. And this will lead to lower revenues and earnings when you report in US dollars. And if your revenues and earnings actually miss estimates that the analysts have for your company, stock prices usually fall, as we have seen previously. Now, the other issue is that a stronger US dollar actually leads to lower export demand. Countries usually like to buy when prices are low. So when the US dollar is strong, countries will usually pull back from buying from the US. And this will affect US exports and potentially can affect GDP growth as well. I hope this was explanation was simple enough and comprehensive enough for you to understand the relationship between Treasury yields, the dollar index, as well as the SPY. It took me some time to figure all this out, to be very honest, given that I have no financial background whatsoever. But ever since I figured all this out, a lot of the pricing in the stock market, when the yields go up and the dollar index goes up, actually makes a lot more sense. And given that the Fed has stated they are not planning to cut rates for at least the next year or so, or cut rates minimally for the next year or so, we can expect this pricing action to be in play for the next year or so. And for investors, it is good knowledge to have. So what now? So three scenarios can happen. One is that the optimists are right. The stock market is oversold based on various technical analysis. The recession has passed, and the stocks will go on a tear from now on, which makes sense to go all in on stocks and buy the dip and buy it hard. The second scenario is that the optimists are correct and the recession is on the way. The stock market will likely to continue to fall, which makes sense to pull out of stocks or to hold on to stocks and use additional cash, or to free up capital to buy treasury bills and government bonds. Now, the third scenario, which is the personal stand that I'm taking, is that I have absolutely no idea what is going to happen. So, an economist is right 50% of the time. A recession either happens or doesn't happen. A technical analyst is right 50% of the time also. A stock market will either go up or go down. For me, I have no idea who is going to be right, and I'm not going to take a 50-50 chance and bet all in on it. So what I'm doing now is I'm hedging both ways. So what I did was I selected good companies. As you know, I have watch lists for various companies with strong financials and can manage their debt at higher rates because of their debt management. And I bought 3 additional positions when the valuations came down to below their median PE ratios during the current slump in the stock market. At the same time, I have added exposure and already have exposure since the beginning of the year to various funds that are invested in treasury bills and government bonds. So, to me, from a conservative perspective, I would say that I'm hedged both ways. If stocks go up, I profit from it. If stocks go down, the companies survive the downturn, and when the economy goes back upwards, the companies will rise in terms of their stock price. I will still profit if I'm able to hold on for the period of time where the economy is not doing so well. At the same time, a treasury bill or government bond, like I said, will not lose its value unless the government goes bankrupt and cannot pay its bills. And if it's held to maturity by the funds that I'm invested in, there will be no capital loss but an interest gain instead. So if a recession happens, that gain is still locked in terms of the interest that I'm going to get through the fund by its dividends. So that is what I'm doing. I'm not sure how everybody else thinks about the current market, but these are the three scenarios that are likely to play out. Like I said, it is hard to predict how things are going to go, and I myself will not go all in either way. But different people have different risk appetites and different views on how economic conditions are going. Some with financial backgrounds or economic degrees and stuff like that will have a much more, I would say, much more experience in terms of analyzing this data. But what I'm doing is from just the everyman who has got basic financial knowledge from reading up and educating myself because I'm investing. And this is how I am managing the current situation in terms of treasury yields, the dollar index, as well as the stock market action. So I hope this video was informative and will help you in your investment decisions over the next year or so as interest rates continue to remain elevated. Thank you for watching, and I hope to see you in my next video.